Okay, hello everybody. Welcome to Karina Lanta Mentorship. I am watching a TikTok profile of a fourth year medical student, and there was a video of her talking about her debt. So let's go ahead and take a look and see what's up.
I cannot sleep because I am so stressed out about my med school student debt. I just matched a few days ago into my dream program that I could have never imagined I would ever match into. And still, it's hard to fully enjoy because all I can think about is this.
Hold on, let's full screen that. $508,233.57. 508,000. And I'm guessing some of this has been deferred because there's interest in that mix, right? So $51,000 of interest, total outstanding, $450,000 of principal. So for a total of $508,000, you get to be a doctor. All right. I wonder what med school she goes to.
This is terrifying. This is my current student debt that I checked most recently. I'm pretty sure this has all 4 years included. And this is my bank account currently. I'm actually so excited about the $28 because that's more than I usually have. I did some calculations trying to figure out when this would all be paid off if I did like minimum payments or tried to pay it off aggressively, and I just got so overwhelmed that I had to stop. I'm seriously concerned
Don't worry, don't get overwhelmed. I can do an example for you.
about my ability to ever own a home or even buy a car. I did not go into medicine because of the money, but I did think that I would be.
I don't think you should be ashamed that if you go into any profession for the money, right? I think that kind of needs to stop. Like I know like there are so many people out there who feel like they have to volunteer like villages in Africa, but in the end what are you doing it for? So you can get that salary, right? Like that nice doctor six-figure salary. Don't be ashamed.
Financially stable at minimum. And for some context, I'm the first in my family to go to college and to go to med school. And I thought there would be a time where kind of all that hard work would pay off and we would have we would struggle less and just feel more stable. So yeah, it's just a little bit jarring and I don't know what to do. I cannot sleep because I am so stressed.
Maybe she should practice these spreadsheets and she might feel a little bit better. But she only has $28 in her bank account. Oh no. So I kind of did a Google search about how much if you should be making if you had about like $500,000 of med school debt, what should my salary be? And so at least 250 and possibly 350K plus, right? So I have a spreadsheet here. After tax, I think 260K in many places in the world or in the US is probably like 14, 15 grand. I put 14 grand here. So what I did is I created a simulation of a $500,000 student loan and oh, this mortgage, is this right? Oh, this is not right. $480,000 mortgage. I was like, something's wrong. So let me just do this. Yeah, $480,000 mortgage for a $3,000 a month payment because I'm assuming she's gonna live it up. I heard doctors, they go through great sacrifice and then they splurge it up and can't control themselves after they get their first real job. So it seems like here we're at a negative $1,245. So I'm going to be a little bit generous. If you have half a million student loan debt, even though the amount of student loans that you have does not correlate to the amount of income that you produce, let's just say you make about 16,000 a month after tax, which should be really good, right? So if I have 500K of student med school debt, which my salary would be 250 to 350 at least, right? So you need to make good money in order for you to service that debt. And assuming that we maxed out on credit cards, maybe we got a Toyota or something, and who knows, maybe when she graduates or she does finishes her residency, cost of auto loan average probably 30 or something like that. student loan 500,000, mortgage 480, and then we'll assume that she's has $3,000 a month in personal expenses, food, gas, insurance. And so now we see that we're in a really tight budget here, right? Really tight budget, even though we make really good money. Okay, so what we're going to do is see what we can do to pay off that $500,000 student loan debt at 7.6%, right? That was the average listed in the video. If I can fast forward,
Currently,
$28, $28 here.
I'm pretty sure
Yeah,
this.
7.6% interest rate, $508,000. And so now what we're going to do is, even though in her case it was $28, let's assume she has 754 left over. We're not going to have zero checking, zero savings, and we're going to do something called velocity banking. So this is not financial advice. This is just a educational demonstration. You got to have disclaimers. Results not typical. Am I right? So what we're going to do here is, let me just kind of take a look at this, is when we create our budget, we have to make sure that every single debt is its own line item, right? And then what we're also going to do is calculate something called the cash flow index. So all it is your debt amount divided by the payment, and then it gives you an arbitrary number. And the lower the number, that's the one you want to pay off first. Why do you want to pay off first? Because if you pay off these lower numbers first, you get more bang for your buck in terms of cash flow, right? Um, I mean, think about this, right? Like, let's just compare just the student loan and the mortgage. I pay off 500,000 to get about $6,000 back in my cash flow, or I could pay 480,000 to get about 3,000, right? So obviously, this one will give you more bang for your buck, and the lower the number, the more bang you get for your buck. Okay, so now what we're gonna do is we're gonna assume we have access to something called a line of credit. So there's various types: personal lines, business lines, home equity lines, and we'll just say we have. Uh, we'll say for the sake of argument that we have only $100,000 home equity line of credit, and that could be possible, especially if you have a mortgage in the $480,000 range, right? Like you could possibly have like that much equity and then use it as a line of credit. And what we're gonna do is just consolidate some debts, throw all of our money into that line of credit, and then take our expenses out and rinse and repeat over and over again. So, right, so 5, 8, 15, 27, 30. I'm gonna go ahead and sum it all up. That's 85,000. So what we do is we take these low cash flow index numbers, 85,000, 85,000, and then move it into the line of credit. And so our final step is we're going to take our entire paycheck, move it into that line, take our expenses out, and then rinse and repeat over and over again. All right, so it's going to go ahead and do that. And then now what we're going to do is we have to actually update our cash flow, because here we move 85,000 into the line of credit, and really what do? We just essentially did a balance transfer. So if we did a balance transfer, that means these credit card payments essentially go to zero, and then now our cash flow is about $3,500, right? Same income, same expenses, we just shuffle some debt and then increase that cash flow. All right, so now what we're going to do is to get the next month's balance based on the previous month's balance, previous month's interest minus our cash flow. So 35882.07. And then what we do is we take the average daily balance, right, multiply by the interest rate, and then divide by 12. That's how we get the interest for the month. And then let's see how fast we can pay off, whoopsie, the debt, right? So this is just focused on credit cards. We're still making the payments for the auto, the student loan, and the the house, right? And then we see that in 26 months, we pretty much paid it off, okay? 26 months. So now what we're going to do here is write 26 months, 85K, that is gone, right? So, and then we have 3 more right here, okay? So now let me just do this. So I'm going to type in 26. So this is our loan calculator that tells us the balances of our loans, and it also tells us the current cash flow index. So we just use this right here. It's the current balance at 26 months. And then what we do is we move the balance of the auto loan, the current balance of 11 grand, plus 11699.81. Okay. And then what we do is now that we move the balance of the auto loan here, we get an extra $300 back in our cash flow. And then now our cash flow is almost 4 grand, right? And so now what we're going to do is update that cash flow to 3,000. So when we do this, so 3941.45. And then we're going to go ahead, copy and paste. And then we see that in 29 months, the auto loan is paid off, right? So 29 months, all right, and that would be 105K. And now all we have is the student loan and the mortgage, right? So what's the balance of the student loan here? So it'll be 2929. So you'll see it's about 411,000. Now we don't have a line of credit that's like at 411,000, right? Um, that would be pretty that would be a pretty huge line of credit, 411,000. But what we can do is we can do something called chunking, which is just taking a piece of a loan and moving into the line of credit. So that's an alternative that we can use. And so what we do is just move or use this calculator, which is really called it's called Velocity Banking Calculator, but you're just moving a chunk of the loan into the line and see how fast it pays off. And again, just use a cash flow index. So you just follow the order. And so if 500,000 is the original balance, and then the current balance is 411. We just moved the data or the current figures here, right? All right, whoopsie. All right, so let's go ahead and do that. And then it's 7.6 is the interest rate, and what's the payment? It's 5961.22. Okay. All right, so now let me just go ahead and do this. And then what we do is we just copy the income and expenses. So the income is about, let's say, 16,000 a month after tax, 16000. And then the living expenses is everything except for the loan you're trying to pay off. So that would essentially just be these two right here. So it'll be 6097.33. So 6097.33. And then we'll just do a 16,000, whoopsie, $16,000 chunk. Whoopsie, where does it go? All right, 16000. And then we see that the med school loan pays off in about 4.1 years, right? So now this is 0, okay? And then this is 29 divided by 12. Oh, actually, let's do this. Plus 4.1 times 12. So that'll be 79 months. And then that would be 605K, right? Whoopsie, 605. 605K. All right, so now at 79 months, what's the balance of the mortgage? So we'll just do this right here, 79 months. So it's 438,000, right? And then so now we just do the exact same thing. So this one's going to be let me just redo everything here. And then so now monthly living expenses is 3,000 a month. 30-year mortgage. Payment amount is 3097.33, so 3097.33. Interest rate, I believe, 6.7. And then what's the original balance? It's 480, 480, 000. And then the current balance is 438,703.75. So 438,703.75. Ooh, paid it off in 3.2 years. Okay, so now we go here. This is 0. Then let's just do the calculation of the length or the term of how long it takes to pay off. So divide by 12 plus 3.3 what was it? 3.2. 3.2. So that would be means that in about 9.8 years we are debt free. And how much debt was that? That's about 605 plus 480, about 1.08 million of debt paid off in 10 years. And look at that. So now we are going to have 13 grand of cash flow per month, assuming our expense is about 3,000 a month, right? 13 grand. All right. Well, and we have no more housing payment either. Okay. Well, so right here, the title is Praying It Works Out in the End. So I pray the same for you, Mimi Sharif. I think that's your name. And yeah. All right. Well, that's it for today, folks. Another video, 2 videos in one day. Happy Easter. It's maybe because it's Easter, I'm feeling a little generous with 2 days, or sorry, 2 videos in one day. Have a great day, and I'll see you on the next video.